Let's run a thought experiment. Imagine India's largest economic partner, the United States, just slams the door shut, out of nowhere. It's a hypothetical scenario, sure, but it forces us to ask some really important questions about what economic resilience actually looks like in a world that feels like it's fracturing by the day. So what sets this whole thing off? Well, let's say it's a perfect storm of diplomatic friction that boils over. And we're not talking about a minor trade spot here. This is a full-blown economic shockwave aimed right at the heart of India's entire export economy. So let's play this out. What actually happens in those first 90 days? Because a crisis like this, it does more than just expose vulnerabilities. It also reveals some surprising, almost hidden strengths of the Indian economy when it's pushed to the absolute brink. All right, first up, let's talk about the immediate impact of this absolutely unprecedented tariff. The first few weeks, it's just pure chaos. Businesses are scrambling, phones are ringing off the hook, everyone's trying to figure out what just happened. And this thing escalates fast. I mean, incredibly fast. It kicks off on August 1st with a 25% tariff, which is already a huge deal. But then, less than a month later, another 25% gets slapped on top. That brings the total to a staggering 50%, one of the highest tariffs the U.S. has ever imposed on a major trading partner. And the financial fallout? It is immediate and it is huge. By October, the trade deficit, that's the gap between what India earns from selling stuff abroad and what it pays for imports, it just explodes to a record $41.68 billion. The country's basically bleeding foreign currency at an absolutely alarming rate. And you can see exactly why right here. Shipments to India's single biggest customer, the US, they just collapse, dropping by almost 9%. And because the US is such a critical market, that drags the entire country's export performance down by 12%. We're talking orders canceled overnight, containers literally just left sitting on the docks. You know, numbers on a chart are one thing, but this is where the story gets really painful because the true cost of an economic shock like this is always measured in human terms. It affects millions of people's lives and their ability to provide for their families. We're talking about India's crown jewel here, the famed IT sector, a symbol of its modern global ambition. And it is facing what one analyst actually called a potential IT apocalypse. 500,000 high-skilled jobs in tech hubs like Bengaluru and Hyderabad are suddenly, terrifyingly on the line. So here's the really important thing to understand. This crisis, it didn't create a brand new problem. The US tariff didn't break the Indian IT model. It shattered an already cracking foundation. The old way of doing things, that digital assembly line of coders, was already fading out. This shock just forced the transition to a new reality, one that demands specialized skills like AI and smaller, leaner teams to happen almost overnight, brutally immediate. And look, this wasn't just a white-collar problem. The pain was felt even more intensely in these labor-intensive industries: textiles, gems, leather. These are the sectors that employ millions and millions of semi-skilled workers, and they were just hit by a tidal wave of canceled orders. So with a hit like this, you'd be forgiven for thinking it's game over, right? You'd expect a total economic collapse. But that's where this whole story takes a really unexpected turn. It happens when we stop looking at the ports and start looking inside India's borders. The official response from New Delhi, it wasn't panic, it was pure defiance. The message was crystal clear. India will not be a passive victim in some trade war. And this wasn't just political talk. It was a signal of a massive strategic pivot. And this chart, this right here, is the secret weapon. This is why they could afford to be so defiant. I mean, look at it. For all the talk about India as this big export powerhouse, the real engine of its economy is overwhelmingly domestic. A whopping 70% comes from its own people buying things. And that tiny little slice for net exports, it shows you just how insulated the core of the economy really is from global trade shocks. So think of it like this, that massive internal market. It acts like a giant economic firewall. Now, it can't stop the damage from the external shock completely, but it absorbs a huge portion of the impact. And that's what prevents a total nationwide collapse. The spending power of over 1 billion consumers is a pretty powerful defense. So with that domestic buffer holding the line, the government had the breathing room it needed to stop playing defense and start playing offense, launching a major strategic pivot on the world stage. And what they did was activate this long-term strategy they call Atmanirbhar Bharat. Now, it's really crucial to get this right. This doesn't mean Fortress India closing itself off from the world. It's the exact opposite. It's about building up domestic manufacturing capacity so that India can compete with anyone, anywhere, and reduce its dependence on any single market. And their game plan was super clear, a real two-pronged attack. First, diversify trade. Get on the phone and aggressively fast-track deals with new partners. Second, boost self-reliance. Strengthen the factory floor at home with programs like the production-linked incentive schemes, which basically give companies cash back for making more stuff in India.
And they didn't just talk about it, they moved. Fast. A big agreement with the UAE opened up a vital new channel. Those high-stakes negotiations with the European Union, suddenly on the fast track. And existing relationships with Southeast Asian nations and Australia were deepened significantly. This crisis basically forced a fundamental rewiring of India's trade map.
Meanwhile, around the world, a lot of international observers were just stunned. They were looking at the U.S. and thinking this wasn't some masterstroke of policy, but a major strategic blunder that was undoing decades of careful diplomacy. And then you had key U.S. allies like Germany publicly coming out and, well, basically siding with the principles of free trade. It was an indirect but very clear signal of support for India's position, and it just added more diplomatic pressure on Washington. Okay, so let's take a breath. After 90 days of absolute chaos, pain, and some seriously slick strategic maneuvering, what's the new reality for the Indian economy? What have we actually learned from this whole stress test? It really boils down to this incredible contrast, doesn't it? On the one hand, the shock was severe. Record trade deficit, plunging exports, major job losses, panic in the markets. But on the other side, it revealed this fundamental resilience that a lot of people had underestimated. A resilience built on that huge domestic market, a quick pivot in trade policy, and a flat-out refusal to compromise its strategic autonomy. So what's the bottom line? Let's be clear. This is a severe blow. Losing 1 to 2% of GDP growth isn't just a number. That translates to immense hardship for a lot of people. But it is not a death blow. The crisis forces a painful but maybe necessary reorientation. It pushes India to accelerate its journey to become a more diversified and truly self-reliant economic power. And this whole scenario, it leaves us with this massive question. And it's not just about India anymore. While India survived this hypothetical shock, it serves as a powerful reminder for every single country out there. In today's world, which is getting more unpredictable by the second, is economic resilience now just as important, if not more important, than economic growth?